Hello, everyone. Today on the Final Bar, I'm joined by Erin Swenlin from DecisionPoint. It'll be awesome to have her on the show. Share with us some of her charts and what she's seeing at the top level indexes. Overall, the market in a choppy environment. Yesterday was big time distribution after the Fed minutes released in the afternoon. Today, a little bit more about processing that. But even though the market averages are flat, with the S&P not too far from where it was yesterday, plenty of movement in individual sectors. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the technical analysis toolkit, using the power of stock charts to better understand supply versus demand, fear versus greed, all of those competing forces that net out to the market activity. And when we talk about 2022 and what might be in store, when I've been asked about it, I've explained things like elevated volatility, elevated uncertainty, and days like today and really this week. So far, 2022 is playing out sort of with those adjectives very, very nicely. You're seeing plenty of chop around. And even today, again, where the S&P was flat, the S&P basically closed yesterday around 4,700, spent the day a little bit below, a little bit above, but netted out right about at that same level. But underneath there, if you look at some of the sector movements, you're seeing plenty of differentiation between what's working and what isn't. On a day like today, you have energy up over 2%, energy stocks, that is financial, the financial sector up 1.5%. On the downside, you have materials and healthcare both down over 1%, as well as utilities. So this could be another one of those times where the major averages have a certain look, but some of the individual stocks and sectors actually have a very different look. And for me, this is a beautiful lesson, a beautiful reminder on the value of using technical analysis and using charts to not just speculate on what may work, but actually focus on what is working. We have such great guests on the show. I'm excited to talk to Erin Swenlin here in a short while. It's very good to have her back on the Final Bar. Next week, we have three good guests lined up for you. We have Bill Baruch coming on, joining us on the first for the first time on the 11th. He's from Blue Line Futures. On Wednesday, the 12th, Dana Lyons from J. Lyons Fund Management and editor of the Lion Share Report. On Thursday, the 13th, Mary Ellen McGonigal from MEM Investments coming back on the show. Coming up the week after, on Tuesday, the 18th, Andrew Thrasher from Thrasher Analytics joining us. A number of great market outlook specials happening this week and next week on StockCharts TV. I would encourage you to check out all of this great content on StockCharts TV on demand and also on our YouTube channel. We have Larry Williams with a market forecast special coming up this Friday, the 7th. Next week, we'll be featuring a special with Martin Pring, interviewed by Bruce Frazier, talking about his cyclical and rotational outlook for the year. We also have our major special event called Charting Forward, which is coming up on January 18th. Some fantastic guest presenters, Tony Dwyer from Canaccord Genuity, Gina Martin Adams from Bloomberg Intelligence, and many, many more. So check out all of those specials, of course. Also, I will be presenting at the Money Show coming up next week. I'll be doing a presentation called 7 Questions to Ask Before Every Trade. I'll be going through my technical analysis toolkit and talk about a disciplined way of analyzing stocks using a consistent approach. I'll share with you my checklist and how I actually go through it and go through a bunch of examples and challenge you to develop your own technical checklist. Go to stockcharts.com/money show to sign up for that event coming up next week. Let's continue on today's show with our market recap. As I mentioned, the market can go three ways. It can go up, it can go down, which is arguably what we saw yesterday, and it can go sideways. And that third direction, sideways, is often the most painful and the most frustrating because it's an absence of trend. It's more of a consolidation. And today, I guess you would describe as a digestion day. If yesterday was the big meal where the market sold off so aggressively into the close, today we really didn't lose any more ground at the end of the day. It was more about digesting that meal. And the question from here is what's next, right? Do we bounce off of 4,700 and rotate to new swing highs to 4,750 and 4,800 and beyond? Or was that sell-off that we saw into this week just the beginning of something deeper and going down to test the level like 4,550 or something like that? Let's look at what actually happened today. The S&P, as I mentioned, closing just below 4,700. The Nasdaq 100 flat as well. The S&P mid cap and S&P small cap indexes both actually appreciated, with the S&P mid cap up 0.5%, 0.2% higher for the S&P 600 small caps. Energy and financials were the top two sectors, and in that sort of configuration, usually mid caps and small caps are going to outperform the S&P, which is way more geared toward growth stocks and things like technology and consumer. The VIX is actually just back below 20. It tipped above 20 yesterday at the close, if I remember right, coming off just a little bit from yesterday. Interest rates continue to push higher, and that was one of the big catalysts yesterday, particularly in the afternoon, with the release of the December minutes of the Fed meeting. And again, I think it surprised a lot of investors in terms of the language that was used, which was, really talking about a little more aggressive approach to this year and next year from the Fed, and becoming a little less, if not a lot less accommodative for the markets, and certainly translating that into higher rates and weaker stocks. We saw 10-year yields go higher, get above 170 yesterday, continue to push upwards, nearing 175. And if you look at the chart of the 10-year yield, that's $TNX. This is the chart we usually use for it. So I have these shaded areas which indicate the upper end of the range over the last 8 or 9 months, which is 170 to 175. The lower end of the range, which we've obviously broken a number of times, but I sort of set this up back here in the spring, early summer months, 150 to 155. And as you can see, we're now back in the upper end of that range. So we've gotten above the October and November highs. We're now testing the highs from March, the highest levels in 2021. Getting above there potentially signals a much higher rate environment. Now, what I would tell you is, given the language that we saw from the Fed, not just yesterday with the minutes, but just in the meetings and Powell's press conferences, certainly suggests the prospect of higher rates is a very real issue. The yield curve steepening as the longer end is elevated over time certainly indicates potential tailwind to things like financials and some of the cyclical sectors, a headwind or a weight on some of the technology shares. And if you look at what's happened in some of these days, you see a day like today with technology down and something like energy and industrials higher. That's sort of that general move of value over growth. And that's what should generally happen given higher rates. That tends to be, and again, a tailwind to cyclical sectors and a headwind to growthy sectors like technology. And it's about how they're valued, and arguably overvalued, very high valuations, and higher rates don't tend to do very well for growth stocks that have had pretty good runs so far. So you're seeing that play out this week. The question is that more of a sustainable event that plays out through the course of January and beyond? Gold coming off, and I was actually talking with Tim Tashler, who's has been on the show before. Hopefully we'll get him on very soon. I was talking with him yesterday about gold prices. In general, when you're thinking about gold, it's interesting with the prospect of higher inflation. It's interesting with higher rates that are starting to materialize. You're really not seeing gold go higher. And usually higher rates tends to mean higher gold. That's a sort of a consistent pattern, but you're not really seeing that. Gold really hasn't served as a safe haven. Even when the market's coming off yesterday, you saw gold prices come down as well. So if inflation is a consistent concern, gold is not really telling you that that's the way that people are trying to ride out that risk of higher inflation. Silver prices down today as well. Cryptocurrencies are all over the place, but in general, a lot weaker. And yesterday was as stocks were in sort of that risk-off mode. You saw that with cryptocurrencies as well, with Bitcoin, with Ether, with most of the major coins that we track all down today or yesterday. Today, a little more choppiness, a little more sideways. Ether still leading the way to the downside. Looking at these 10 most liquid coins that we track on our main dashboard page. Ether down just over 3%. Bitcoin hovering just above 43,000, but it's been much of the last day below that 43,000 level. 44,000 was sort of the level I was looking at. Below there, I think you go down to 40,000, and so that's what I would be looking at now. We're sort of in that potential support range. Let's finish off just looking at a couple quick, charts. When I'm looking at the S&P 500 chart, we today got down right to the penny to the 50-day moving average. I have to remind us that we've tested the 50-day moving average a great many times in the last 12 months, and all but one of those we've closed below the 50-day moving average one session, and that was it. And then the immediate next session closed back above. And if you look back at the last 12 months, you can see that that is actually literally the case almost every time. It happened like 10 to 12 times as I'm glancing very quickly. Anytime if you close below it, or it's sometimes even just traded below it the next day, bounced up just fine. So buying the 50-day was a consistently positive approach. The only time that didn't really materialize was in mid-September of last year, where we broke below the 50-day. We undercut the August low. This is when I remember getting pretty cautious on stocks because it felt like this could be the beginning of something much deeper. From there, though, it rotated back up, was able to regain those previous highs and break out. And then you have a phenomenon called polarity, where a level of resistance becomes a level of support. Right now, we're testing that polarity concept at 4,700. 4,700 was resistance in November and December. We broke above there, retested that level from above. I would argue right now we're at 4,700 on a closing basis for the last two sessions. We're right at the 50-day. The question is, does that level hold? We need to take a quick commercial break. We'll be back with my guest, Erin Swenlin. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down the market activity using a bunch of charts. And I would argue, as I've told my own premium members and our viewers for a long time, a consistent but imperfect process, I would argue, will always beat a perfect but inconsistent process. I would get in a routine of looking at a good set of charts. And my guest, Erin Swenlin, here in a few moments, you will see, does a fantastic job of just that, having a good routine of looking at a consistent set of charts. Before we get to Erin's appearance here in a moment, just want to remind you, questions that you have are very, very welcome. Feedback on our show, on our guests, on your host, all of that is very welcome, but especially questions that come up as you are trying to analyze your own charts. What questions come up as you are trying to use the technical analysis toolkit? Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. Such fantastic content every trading day. The DecisionPoint show featuring Erin Swenlin and Carl Swenlin as well. Chartwise Women with Erin, which Erin appears on every week as well. And all the great year in review stuff from December, our market outlook content in January, so much more from our website, StockChartsTV.com, or on your mobile device. Just search for Stock Charts TV on demand on any of the app stores. I want to welcome on today's guest, Erin Swenlin. Erin is at DecisionPoint based in California. Always such a great perspective on the market and using the DecisionPoint methodology. Erin, welcome back to the show and thanks for joining us in the new year.
Absolutely. It's so great to be here. And I brought some of our specialized analysis tools from our toolkit that we do on decisionpoint.com. And I think it'll be really interesting for folks.
Very, very exciting. We're starting with the S&P 500. There's a lot going on here, a lot of different indicators, but talk us through what you're seeing with the markets here.
Okay, so this is our very, very short-term climax analysis chart. So you'll see those red verticals and those green vertical lines. Basically, when we get total volume getting total volume really accelerated and very high, we know that we're looking at a possible climax day. So what we do is we look at volume ratios for the S&P and the New York Stock Exchange. And if we get a volume ratio above about 3 is our threshold, it constitutes a climax day. And you get an upside, those are the green ones, and the red ones, of course, are downside. But the big thing is that we have to determine, is it an upside initiation or an exhaustion? And we had one yesterday come in, a climax. It was a downside initiation climax, meaning we would expect the next day or two to see lower prices. And the reason it was a climax, you can see very high volume ratios to the negative side. And then you look at breadth, net advance declines, net advance decline volume, and you can see that those also had moved past our threshold. So climax analysis is something that's only at decisionpoint.com, and it does give our short-term traders a really great understanding and a way to kind of think about what may be happening the next day or two, because these climaxes tend to be really, really accurate for the next day or two. And I could go through this chart and go through all these climaxes, but we'd be here forever. What I would note is that you can see we've had these periods where we had a lot of climaxes come in, and that's just a function of the volatility. And it does make us, when we get those climaxes, it's kind of like, okay, this is what we expect, but, we're getting them like every day. So they're very helpful regardless, I think, for giving you an idea of what might happen the next day.
Now, we've had rates obviously going higher so far now in recent weeks, and a lot of focus on technology. We're looking at the Nasdaq 100 second, taking a little bit step back, a little more of a longer term view. Talk us through this one.
Yes, absolutely. So we do what's called bias assessment, and I've got the Nasdaq 100 right here. The cool thing is that we have these indicators called the Silver Cross Index and Golden Cross Index. And basically, it just measures how many stocks for the Silver Cross have a 20 above their 50-day EMA. And the Golden Cross Index tells you how many stocks have their 50 above their 200. So one of our concerns has been that you're seeing very thin participation. You don't have a whole lot of stuff. When we're sitting here getting, we hit new all-time highs, we should have better participation than what we've been seeing. We also look at the percent of stocks above their 20, 50, and 200. And I assess the bias of the market in all three timeframes based on comparing those participation percentages to our Silver Cross and Golden Cross. And as you can see right now, the percent of stocks above their 20 and 50 as of yesterday, we haven't updated yet, but those percentages were much lower than that Silver Cross percentage, which tells you that we're going to see more damage on that SCI, and that the bias right now in the short and intermediate term is bearish. Right now for the NASDAQ, we also have a very bearish bias in the long term, because you have only 58% of stocks above their 200, and you have 69% with a 50 already over their 200. They're on golden crosses. So when we see the deterioration of that participation under the hood, is what I like to call it, it gives us an idea of where we might be going. And honestly, we don't have oversold readings on participation or on the Silver Cross and Golden Cross. It just doesn't look good right now. I don't see where we're going to get the push from those stocks underneath to really keep that index up or really help us see a reversal. So I'm pretty bearish right now in all three time frames, particularly on the NASDAQ 100.
So we only have about 30 seconds left, Erin, but I'd just love to ask you, given the weakness that you're showing with the short term, but especially on the longer term here, and the weakening breadth characteristics, where do you go right now? Is it the time to get defensive, or is it the time to look opportunistically at particular areas? Where are you looking right now?
Well, I have to say, I tell all of my subscribers my exposure to the market, and I'm at 10%. I just personally pulled myself out. But for those of my subscribers, obviously a lot of traders, I've been talking about in my DecisionPoint Diamonds reports, that's my stock pick newsletter. And I've been really starting to highlight those areas like staples. Yesterday, I talked about high yield stocks. That's kind of where I would be looking. Energy obviously looks good right now. Financials have a really good opportunity with rising rates. We tend to see pretty good action out of the financials, banks. So those are kind of the areas I'm looking at right now. But interestingly, utilities and real estate, not really the place to go. And I'm with you. Nobody's going into gold,
Right. Which is a bit surprising, but you're right. Some of those pure defensive plays like utilities, you're really not seeing a bid right now.
No.
But appreciate it. Listen, Erin, it's awesome to have you on. Thanks for talking through some of those charts and sharing your outlook with us. Be safe and be well down there in California. We'll talk to you again soon.
Absolutely. DecisionPoint.com. Come see me.
Thanks so much. That's Erin Swenlin. Erin's at DecisionPoint.com. Her father, Carl Swenlin, is one of the most celebrated or certainly, successful technical analysts, built a fantastic methodology. And Erin has done such a great job of applying that methodology consistently. And I love that talk about participation. If you think about that chart of the Nasdaq 100, the Qs, and looking at, look at where the Qs are making new highs, and look at some of those breadth readings, just well below what you would expect. And that shows you some of the weakening characteristics, particularly in growthy areas like in the Nasdaq. Great take there from Erin Swenlin. Let's continue on with our next segment, Getting Sentimental. So a lot of the weekly sentiment data is updated Wednesday into Thursday. So it's a good time on Thursday's show to take a look at some of the sentiment indicators and have a sense of where they're at. So what we're going to do is with sentiment, we'll look at a couple different things. We look at volatility. So we'll start with the VIX. We'll look over at some of the survey data. So things like the AAII survey, the NYMEX, not the NYMEX, the name exposure index. I just went commodities all of a sudden there. Sorry. The name exposure index, looking at money manager survey data, and then also things like put call ratios, looking at the options market to get some color. So starting with the VIX, right? So the VIX is up yesterday, and in general, it tends to be an inverse relationship, right, between the S&P and the VIX. That's why it's called the fear gauge. And the way I generally try to describe this, volatility can go up when the market's going higher. It's just not super common. Volatility can go down when the market's going lower, but it's not super common otherwise. And the reason is because when people really start panicking like they did in February, March of 2020, you usually don't calmly and rationally go and start lightening up on some of your positions. You panic and dump everything, especially when you start to see your positions lose money and show brighter and brighter red on your screen. That's why volatility tends to spike during sell-offs, and that's why it's considered the fear gauge. Although, to be honest, it's not measuring anything other than the implied volatility. It's looking at the options market for the S&P, and it's actually looking at where those are actually trading, and using that to infer or to imply a volatility for the S&P 500. So given the sell-off that you saw yesterday, you saw the VIX pop higher. It's right at 20. Now, in general, what I was taught learning technical analysis a number of years ago was that the VIX above 20 or maybe 25, depending on the volatility regime, that's elevated volatility where you start thinking more about downside protection. You start looking at a bull market phase for opportunities where there might be a good entry point, given the fact that a lot of investors are getting shaken out during low volatility periods. It tells you we're probably in a slow and steady upward gain. So you saw a spike in volatility at the end of November when we pulled back there. In December, if you look, the trend in the VIX went from 30 down to around 17, which is where we ended last year. Now we're turning back higher and going above 20. That's that blue shaded line that you see there. And you can see last 10, 12, sorry, this is a little more. It's about 18 months. You can see we spent about half the time above 20 and about half the time below 20. And during that, the bulk of this uptrend in 2021, the VIX remained between about 50 to 20 with occasional spikes above 25. Now we're going back to that elevated volatility environment. What I would tell you is if we get a VIX above 20, which we're kind of right there, but not quite, if we start to get above 20, that's when I will be looking for buyable dips. Given the strength of this bullish trend, that has been a fairly consistent approach, is look for a spike in the VIX, look for a buyable dip, potentially a time to buy in on some names that are beaten down a little bit. We're not quite there. We're sort of in the middle of the range that we've been in the VIX for the last 18 months or so. Now, the AAII survey is looking at individual investors. We're looking at the bullish respondents in green, the bearish respondents in red, and then the spread between the two at the bottom. I didn't update my little horizontal line, so I'm going to do that here. What I like to do is just put a horizontal line at the current level. And this was a trick that I learned back in my Fidelity days in the chart room. This is a common technique. Edward Tufte is known as like the father of data visualization, or certainly an expert in data visualization. That was one of his tricks that he talks about in his books. And so I got in the habit of doing that. It's good to show where we're at relative to where we've been. Now, if you look at the last 6 months, you can see that the current bullish rating just below 33%. It's pretty much average. It's kind of the middle road of where we've been. But if you look from November of 2020 through the summer of 2021, which is the last time you had real cyclical leadership, the bullish survey actually went above 40%, and a number of times went above 50%. It was much higher than it was here. So again, you have the S&P coming off of all-time highs, but you have much less bulls around than there were, even 6 to 8 months ago. The spread between the two is almost dead even. So for every bull out there, there's a bear as well, and that tells you when we're talking about indecision in the market, that's what that looks like on that chart. Now, the name exposure index is looking at active money managers. They get a survey where they can see what exposure they have to the equity markets, what percentage basically, and you can be leveraged long, you can go up to 200% long, and you can go to 200% short as well. It's right at 90% right now, and that's up from about 50% just 3 weeks ago. So when the market pulled back in December, this indicator went way low and is one of the lowest readings that you've seen in the last couple of years. From there, we've come back up above 100%. I would consider that euphoric or too bullish. We're not there yet. We're sort of in the mildly kind of okay, middle of the road bullish. Tells you that money managers are not all in buying into the most recent bounce going into year end. They're still a little bit cautious. Getting above 100%, I'll definitely tell you when that plays out, and we will be warned together. That's all the time we have for getting sentimental. As a reminder, this sentiment chart list that I use is part of the Mindful Investor chart pack, or I think it's called the Morning Coffee Routine chart pack, excuse me. So go to your dashboard. You can access in your chart list section, my chart pack, which you'll access all of these charts and much more as a StockCharts member. We need to wrap today's show and go to the 3 and 3 charts in 3 minutes. Let's get to it. Chart number 1 is Amazon. I was asked earlier this week about how the S&P can be, doing one thing and certain stocks are doing others. So, so for example, you have a lot of breakouts. I asked Erin Swenlin at the end of her take today, where she was looking, and she echoed a lot of the same things I'm seeing, which you're seeing breakouts in places like consumer staples, things like Campbell and Clorox, and even, TAP, Sam Adams sort of cores rolling to the upside. Energy like FAANG and COP and PXD and all of these rotating to new swing highs. Financials, a lot of the regional banks like Key and Huntington breaking out. So why is the S&P not looking any better when a lot of these sectors are starting to rotate higher? And it's all about the weightings, I would argue, in some of these sectors. The S&P, and to a much higher degree than Nasdaq, are really weighted towards growthy sectors like technology, like consumer discretionary, in some ways communication services, some of those names. So it doesn't matter if ConocoPhillips looks great and Huntington Banks is breaking out. If Amazon and Netflix and Meta and all of those are rotating lower, the S&P just doesn't have enough cap moving higher to justify. This is why you're seeing small caps and mid caps do a lot better. So it's less about whether the market, quote unquote, is doing well. I would argue the market's doing just fine, depending on what sectors you're looking at. The chart of Amazon is a flat chart with a consistently negative relative strength. That is not an ideal technical pattern. Now you compare that with our second chart, which is the chart of the energy sector, the XLE. Look at how the relative strength is improving. It's threatening a new 12-month relative high this week. The XLE has made a new all-time high every trading day so far in January. So while the Nasdaq is pulling back and showing short-term weakness, while the S&P is coming off of all-time highs and testing support around 4,700, the energy sector is making new highs. The financial sector and a lot of names in there breaking out as well. This also illustrates the concept of polarity. Polarity is where you have a resistance level that becomes support. And I just put a video on my YouTube channel, might not be posted just yet, but it'll be very, very shortly on that concept of polarity using the S&P 500. So check that out. My channel is called Market Misbehavior. Finally, I mentioned a lot of the breakouts that I'm seeing in regional banks in particular. These are the names that tend to do really well in a rising rate environment. The steeper the yield curve, the better charts like Fifth Third and Key and Huntington and CMA, Comerica, and all of those are going to look. All of those names that I just mentioned are breaking to new swing highs. I think those are overall very constructive setups, given the very real probability of elevated interest rates into this year and next year. Charts like FITB could be a great way to play that potential tailwind. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thanks to Erin Swenlin from DecisionPoint.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.